Hello, you're watching Smart Money, and today we're demystifying a unique South African business model, unpacking the true scope of its operations. That's with KAL Group, perhaps more well known as Agrimark, which is the backbone of KAL Group's agricultural heritage, having evolved over the years into a now diversified powerhouse with arms in not only agriculture, but in fuel and retail as well. Joining me for that conversation is Sean Walsh, CEO of KAL Group. Thanks so much, Sean, for joining us. And I'm going to launch straight into things. So for those who aren't familiar with KAL Group or who simply haven't managed to keep up with all of its transitions over the years, give us a snapshot of the company and what it does.
Hi, Alicia. So not many people would know that the company actually was established in 1912 by 6 farmers in the Swartland area of the Western Cape with the intention of buying guano fertilizer. Can you believe it? From Robben Island, of all places. And, that until 2005, the company was very much focused on agricultural value chain and serving the farmers. And today we are a listed company. We do around 25 billion, which I think when I last checked is nearly more than half of Woolworths' turnover. And we employ 8,000 people, so quite a substantial group.
And over the years, I mean, clearly you've been busy with this evolution, right? And along the way, you've hit quite a few milestones. But what would you say are the most significant moments in the group's history so far?
So it's interesting, Alicia, when we go back 20 years, the company went into a period 2005 to 2010 of extensive mergers. It was the period post 1994. Businesses were getting used to doing business in an unregulated environment in agriculture. And out of that, through efficiencies that were being sought, our company was, I think, involved in 13 mergers in that period with smaller cooperatives, and really just using systems to offer those cooperatives a better business environment. But what happened is that the company obviously was just growing in agriculture all the time. All the mergers were just bringing more and more agricultural footprint to the table. And in about 2010-11, we decided to diversify the business, firstly from a geographical point of view. We were very Western Cape based, and we went into a period to do business in more places with more products, more customers, and obviously, attempting to make more money. And the key thing was to pivot away from being reliant on low margin agriculture inputs to the farmers to a more diverse product range with a more robust and resilient product assortment and margin base. And that really led to us to then, in the last 10 years, follow 2 periods. One, firstly, diversification, and then in the period we are in at the moment, an optimization and acceleration of growth period. Now, it didn't just come about. It was very much based on utilizing our knowledge and product knowledge within some of the agricultural input product ranges that we then used and expanded and entered into now large retail in South Africa.
Absolutely. So as it now stands, Sean, what makes KAL different from other players in the retail and agri space? I mean, what's your differentiator or unique market proposition, would you say?
So a fact that not many know is that we have focused that growth and diversification. We have focused on water-intensive areas of South Africa. And the importance therein is that obviously if you focus on the water irrigation areas, your chances of the farmer having a resilient and sustainable production is higher than, for example, doing retail in the dryland areas where it is very, very much reliant on the rain. So that gives the Agrimark footprint in South Africa an absolutely uniqueness. So we are not Western Cape based. We are a national role player, but within that focused on water. So that's the Agrimark side. On the big side, few would know that we're probably the largest multi-branded fuel and convenience operator of sites in South Africa. Then there are a few others, but we are by far the leading independent franchise operator of South Africa. And we have built the ability with systems consolidation in the background to really offer consumers in South Africa a mobility and convenience, offering at those fuel sites. Lastly, I would refer to a high cash generative nature of our business, a business which is pivoted from a low return on invested capital in the agricultural space to a much higher and more ROIC-enhancing space. Another major milestone was us investing in the Blue Yonder supply chain management system, which allows us to, in the background, digitally supply and replenish our stores in a very efficient manner, manage our stock better, manage margins, price, etc. much better, and manage our warehousing and distribution footprint.
It's quite explicit, when you explain the rationale behind the geographic diversification. I want to get into the diversification of your operations themselves, because you've got operations, like you've highlighted, across agriculture, fuel, retail, and convenience, right? I mean, you even sell pet food, Sean. So what's the strategy? How do these seemingly different sectors actually fit together?
So we like calling it a farm to fork strategy. So obviously with all these fuel and convenience expansions, the farmers have blamed me for taking our focus away from farms, but that really hasn't been what we've done. What we've done is we've continued focusing on farm inputs, but the fact of the matter is that farm inputs are a very low margin, high volume game. We talk about 2-3% margins on some of the farm inputs. Whereas on the other side of things, the convenience necessities that we sell at the fuel sites are a high margin, low volume game. So they are absolute opposites of each other. And I always remind the farmers, we sell 6 million pies a year. Where do we get the flour? Where do we get the meat inside the pies? And etc. So at the end of the day, everything revolves back to the agricultural value chain, and it just made sense for us to take part in that whole farm to fork value chain, and picking out all the businesses that actually made sense within the larger group. So from
So you
farm
explained
inputs to
retail
farm
and convenience.
consumables.
Yeah.
Yes. So
Sorry to interrupt, but you explain, retail in that convenience space. What about this entrance into the fuel market, which gives you, I guess, that exposure on the retail front? But I mean, that's petroleum energy gas, which was until recently known as the petroleum company. So how does that work into KAL's agricultural space? How does it complement your agricultural roots? What was the thinking behind that strategy?
Yeah, so, within every single sector, there is a part which has low margin and there's a part which has a better margin. And for years, we focused on the farmer fuel, which is mainly diesel, at low margins, high volumes. But what the big investment brought to the table was at least 45% sales of petrol. And in South Africa, your petrol is regulated and the margin is much higher. In comparison, your margin on petrol is nearly 3 rand and your margin on diesel is on average probably only 1 rand. Now the two move in relation to each other, but the fact of the matter is that we were actually in the low margin, high commodity game. And what PEG has brought to the table is a better mix and higher margin products to the total group's offering, which is highly more cash generative and balances our balance sheet much better.
So, as you've talked us through it, I mean, the diversification strategy has been very deliberate, and one can see the logic, right, in that it strengthens your ability to weather challenges like climate or even economic volatility, which brings, a seasonal volatility to agriculture. So that explaining the diversification, it reduces exposure to single market risks and creates a more balanced revenue stream, right? I've got to ask you, what have been the biggest risks that have come with spreading that footprint to the extent that you have?
So obviously on the agricultural side, your sales are very dependent on the credit facilities that you give your farmers. So having expanded from the Western Cape, where we knew the farmers for 100 years, expanding into the Eastern Cape, expanding into Limpopo, expanding into Mpumalanga, KZN Midlands, we obviously didn't know those customers as well as what we did in the Western Cape. And what risk that brought was a higher percentage of estimated credit losses. And although we manage it extremely well, that has been the risk that has come to the table. On the PEG side, the risk has been that you have sites on routes that could become problematic. For example, the Joburg-Durban route, with the Durban port being very inefficient, in the last few years, has led to some mining companies using different routes like Richards Bay. And if you don't, you can't just up a site and move it to another route. I mean, you are now invested into that site. And you can often see volumes decline on certain routes, which has brought some risk to the business. Overall, though, Alicia, it has been an extremely successful diversification strategy. We have gone from a debt to equity ratio in the last 5 years of nearly 70% down to this year under 40%. Highly cash generative and therefore able to grow successfully without really requiring additional funding, which is a marvelous situation to be in.
Yeah, a very comfortable position to be in, Sean. What companies, could one compare KAL Group to? Who are your major competitors?
Well, that's
out
the
there?
interesting thing. Yeah. The interesting thing about that is that there is not another company listed on the JSE with the same product offering as us. You would have to look at a combination of a building material company like Cashbuild. You'd have to compare that to an oil company like Engen when they were listed, or a Vivo. And then there are no other agricultural companies listed on the JSE. So it is quite difficult. We acknowledge that our investors need to model our business to more extensively, to understand the nuances for that matter. And hence today's session is about demystifying the group and explaining to shareholders more regularly all the good attributes that we've put together.
So Sean, given the position you sit in then, I mean, where do you see KAL Group in 5 to 10 years out from now? I mean, talk us about what is or what looks like a very ambitious 2030 strategy to unlock opportunities. And I guess then further to that, what's exciting you most about it?
Yes, I think it's an important discussion that often our investors say, well, don't peg the amount, peg what you want to do all the time. So what we'd like to achieve consistently as an executive team is to have a compound annual growth rate of above 14%. That will double the company in the next 5 years or close to. It does require an investment of over 3 billion, but we know we will generate EBITDA of in excess of 5 billion, if not 6 billion in that same period. And we'd like to do it with a return on invested capital of above 14%. We are pretty confident that we can. And our debt to equity needs to therefore remain around 40%, with our dividend cover to be able to reduce down to 2.5. Now, what that does is it takes the current EBITDA and it doubles the EBITDA. So that's the result. But what's exciting about it is that on the one hand, we know that the growth from Agrimarks will be driven by market share. And the market share will come from us executing on a digital strategy to make the purchasing decision of farmers so much easier. To put that in layman's terms, is we would like to tell a farmer that his tractor needs new tires before he knows it. And that means we must track the tire. We need to know exactly what it's been doing every single day of the year for the last 5 years to determine that. But there are tools to do that, and there are AI bots to help us make it easier for farmers to do business. And on the peg side, even more excited that we see the future of the peg sites as mobility convenience centers, not fuel service stations. I think that in our language is something of the past. We sell fuel, but in 5 years from now, you'll also be charging your vehicle at a fuel site. You will be spending time in the coffee shop during the charging time of your vehicle, and you will be purchasing essential convenience necessities in that time that you spend there. And we will be focusing on making sure that we have an expanded convenience offering at all those mobility centers. It's very exciting.
Got you. Well, KAL Group's story is certainly one of, what can we call it, reinvention, right? From agri-roots to a diversified future. And it's clear that this business is built for the long term. So thank you, Sean, for not only giving us a deep understanding of what's driven KAL's success up to this point, but also more insight into where the group is headed. Sean Walsh is CEO of KAL Group.